This interview has been abridged from the original interview found in my book, Market Masters, released 2016. Aside from his phenomenal stock-picking prowess, market-crushing returns, and beaming confidence, Jason is built like a truck, a physical asset that perhaps benefits him on the lacrosse field more than it does in the office of Donville Kent Asset Management. An avid field lacrosse player, Jason also personally mentored his two sons in the sport and currently coaches the Edge Lacrosse Elite Travel Team. With no disrespect, though, I'd wager that Jason scores even higher in his hedge fund than he does on the lacrosse field. To say that Jason's brain trumps his brawn is no small claim, but it is nevertheless true. Donville Kent Asset Management, or DCAM, its flagship Capital Ideas Fund, has been the envy of Bay Street. Within just 7 years, the Capital Ideas Fund has beaten the TSX Composite Index by 350% in cumulative gains. That's 350% in alpha, or the amount by which Jason's performance exceeded the benchmark index. From 2008 to 2015, the fund achieved a whopping 525% in cumulative gains. That's a 27.9% annualized return since inception. How did Jason not only beat the index, but achieve such high alpha? Straight from the Capital Ideas Fund letter, Jason says, "Through the application of our focused investment strategy, we search for companies that possess high levels of return on equity, reasonable valuations, and positive share price momentum. Portfolio companies typically have a track record of achieving high returns on equity and are capable of generating high returns on equity for many years without the addition of significant amounts of equity capital other than that which is being generated internally. These companies are run by strong management teams that have a significant ownership stake in the business," end quote. The return on equity ROE metric is crucial to Jason's hedge fund success. ROE is not just a figure, it's an initial hurdle that the company must pass. Jason's rigorous test, ROE greater or equal to 20%, in order for any security to progress to future stages of analysis. During our interview, we discussed everything from Jason's philosophy to his process and his strategy, along with the unorthodox way Jason entered the investment world, starting in the Navy. Jason has curly, gel black hair and wears thick, round glasses. On the day we met, he was dressed down in jeans and a shirt with rolled up sleeves. Throughout the interview, I noticed that Jason's brain sometimes works faster than his mouth. From time to time, he needs to rewind after he speaks, as though he can't vocally articulate his thoughts and ideas at the same rate that his brain produces them. His brain is always working at full speed. If his brain was a car, it'd be a Ferrari. Before starting the interview with Jason, I thought, Jason would be a great guy to have a beer with. He's a guy's guy, on and off the lacrosse field and his hedge fund's trading floor. Here's my interview with Jason Donville. How did you get interested in the markets? Well, I had a lot of part-time jobs when I was a kid. I was always fascinated by the stock market. In the mid-1970s, the province of Alberta decided to privatize the Alberta Energy Company. Any citizen of the province of Alberta could then subscribe for 100 shares down at the local bank branch. And my parents did that. Soon we started to receive annual reports in the mail from Alberta Energy. I would track the movement of my share price of Alberta Energy in the paper every day. My parents probably owned $1,000 of stock, so I just found this to be a really fascinating process. But even if you told me when I was 15 that I was going to become a hedge fund manager, I would probably be skeptical. You only focus your investments on growth industries and new products and services. Why is that? Well, look around. The world is slowing down growth-wise. Most of that is actually explained by demographics. Obviously, the aging and deleveraging of individual balance sheets and government balance sheets and corporate balance sheets has an impact too. But the bigger impact is a result of demographics. When I look around, I think, where does growth come from? Let me give you an example. Leon's Furniture. We don't own it, but it's a great company. They're not going to sell 15% more Chesterfields next year because there's no demographic surge to generate that growth. Where the growth of the world is coming from is new product development and knowledge-based industries, whether it's a drug or a new software system or a piece of technology that nobody owns. Whereas 99% of us already have Chesterfields, and maybe 1% of us are going to replace our Chesterfield. At one point in the last 15 years, none of us had a smartphone. That was a growth industry. We all bought smartphones over a period of 15 years. Indeed, all of the action is in the knowledge-based industries, though the healthcare sector has the added benefit of a very attractive demographic profile. So while there's no demographic surge right now for Chesterfields, there is a demographic surge of the kinds of things that people in their 60s and 70s need for health reasons. How do you select stocks for your fund? We base decisions on an adjusted ROE as opposed to stated ROE because the stated ROE doesn't take into account the difference in the dividend policies of all these different companies. Conservatively, banks are going to make a 12% return per year in the market year after year. And they're going to realize that return in the form of a 4 to 5% dividend yield and a 7 to 8% capital appreciation. So for the average retail investor who wants to own individual stocks, the banks are actually a great deal, particularly if you're going to hold them for 5 to 10 or 15 years, because our banks are really strong. Their share prices might come down just because of market sentiment, but I'm not worried that they're going to be doing any dividend cuts in the future. Again, though, we look for higher return on equity, 20%. Your main focus is on ROE. However, you've said that while the companies in the TSX have competitive products and services, their ROEs are usually too low for you. Not usually too low, they are too low. If you start your analysis by looking at the companies that have really competitive products, you'll find that they're not really profitable. Why? Because of the capital structure and the capital allocation skills of companies. Let's say that you and I enter a partnership to make a new smartphone. It has a very nice gross margin and even an attractive net profit margin. But we built up massive overhead too, and that's where the whole capital allocation game becomes really important. So first, we look for companies with ROE greater or equal to 20%. Second, we look for companies in that high ROE group that are sustainable based on the competitiveness of their products. Third, we assess management's ability to allocate capital at those companies. Once we validate those three things, we typically find companies that we can invest in. But how do you determine which companies or products will be sustainable in the future? I'm continuously looking through my database for high ROE stocks. So that's any company that has an ROE of 20% or more. Then I look at the source of the ROE. Is it coming from leverage, or is it coming from the sale of assets, or is it coming from profit margin? Essentially, return on equity can be broken down into three pieces through DuPont analysis. You've got good ROE and bad ROE. We want to make sure that the ROE is good ROE. Once I've decided that any company is of interest to me, I'll turn them on to my associates and say, give me a two-pager. A two-pager is basically a 7-year history of the company's financials. I often say to people, if you're thinking of investing in two companies and you run the numbers over the last 7 years on both companies and you put them side by side, the good company will leap off the page at you. That snapshot is so important in terms of understanding the difference between a good company and an okay or maybe even crappy company. The reason is because you can fake good ROE in 1 year, but to achieve high ROE 7 years in a row is tough. You can show me the numbers and say, here, this is a company's 7-year ROE track record, and I'll go, I don't even know what they do, but there's probably a really good company here. Here's an example, a simple way to think about it. Let's say there's a company that makes 20 million in profit and has 100 million in equity. Are you following me? Yeah, that would work out to 20% return on equity. Exactly. At the end of the year, you say you make 20 million. So now the equity goes up to 120 million. If management takes the 20 million of incremental profit and just puts it in the bank, if it's in the bank, then they're just going to make 1% on that. So the following year, the return is still at 20 million, just about because 1% interest rate is almost no interest at all. But now let's do the math. It's 20 over 120. The next year after that is 20 over 140. See how fast the ROE comes down to 15%? So when I see a company that has achieved an ROE of 23, 22, 23, 24, 23, 22% over the past 7 years without even knowing what industry they're in, I go, wow, there's something in place here. There's something magical going on here. That's the magic that you're looking for in terms of those long-term sustainable companies. We can do that analysis in an hour, and that tells us whether we should spend more time getting to know a company. Where do your associates get that long-term financial data? We just pull it off CDAR, which is the System for Electronic Document Analysis and Retrieval, a mandatory document system for Canadian public companies, and put those 2 pages together on each company. Those 2 pages look like the reports that Buffett used to read at the local library. That's what we create in-house. Nobody else does it that way. Though if they do it, it's only on the large caps. Buffett used to peruse all of the value line reports. Right. And it's just boom, 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 boom. It's just a straight, give me the financial history of the last 7 years. Okay, that covers how you would determine sustainability. Now, what about management? How do you assess the quality of management? You mentioned they must be good capital allocators. Okay, so here's a bunch of stuff. The assessment of management is something that takes place over time. When you meet with management face to face, you don't get 10 hours with these guys, you get an hour. For our type of investing, we want competitive advantage and then we want capital allocation skills. So most of the questions we ask when we meet face to face with management are focused on those two areas. What's happening in your environment? Anybody new or any new upstarts or anybody thinking about entering your market? Because a great enemy of a high ROE company is competition. If management says, no, we're not aware of anybody who is thinking of entering the market, that's a great thing. Then we get a good read on their capital allocation skills. Now, capital allocation takes different forms depending on what business or industry the company is in. In a lending environment like home capital, where they just write mortgages each year, they don't need to acquire anything or buy anything. Through their network, they can just put up more capital in the form of mortgages. So it's very straightforward for them to lend more money. In the case of a lot of the most attractive industries, though, and the reason why a lot of these software companies are so attractive is that their client relationships are sticky and they're also high margin. Once you get clients, you never lose them. Well, that's the same for everybody else in their industry. Therefore, by raising sales and promotional expenses, they're actually not going to get much more business because the additional business that they're going to try to acquire is actually equally sticky. And then they go to get that certain point where the owner wants to move on, and then the big boys acquire them. Because again, just upping sales and promotion to steal away another client and a sticky business doesn't work. But often you'll hear analysts say, there's no organic growth. Well, this is not an organic growth story. This is growth through acquisition. MTY Food Group, which is all about fast food, does acquisitions, but they also open up new locations. So once again, we look at MTY Food Group, see that their return on equity has never gone below 23%, and determine that they're clearly able to take a year's profits and channel it back into the business to keep their ROE at that level. But so many analysts just talk about the organic growth. That's craziness. Why is just talking about organic growth so crazy? Think about it. You and I get the rights to buy a McDonald's in downtown Toronto, and after a year, we do $3 million in sales. After year 2, we do $3.3 million in sales, and then it just stays at $3.3 million, but the profit margin is massive. However, there will be no organic growth anymore because once that location is fully up and running, it doesn't grow anymore. It just throws off massive cash flow. So saying, let's just up the advertising is just crazy. There's no more growth there. Instead, what we should do is talk McDonald's into giving us a second location. And yet the number of guys that will criticize these quick serve restaurants for the lack of organic growth is crazy. It doesn't work that way. Just visualize yourself as a guy running a McDonald's franchise. Get those MBA and BCom buzzwords out of your head. Do you exit a position if management's return on equity or capital allocation performance declines? I'll use Solium Capital as an example. When I first moved back to Canada in 1999, I met the founders of Solium Capital. There was a guy with the Calgary Flames who was actually working for them as a salesman. Anyway, they were unprofitable, but then merged with another company that brought in a whole bunch of really good technology. It has been profitable ever since. We've owned it off and on. I just recently sold out this year because the return on equity dipped down to 17%. Regardless, it's a good company. For a lot of guys, 17% is still high enough. Who is the top capital allocator in Canada? Mark Leonard, the CEO of Constellation Software. Who else? Most of the companies we own have people running them that are very good capital allocators. Because if you can keep your ROE over 20% year after year, you almost by definition are a good capital allocator. But as the company gets larger, capital allocation becomes more a corporate skill as opposed to an individual skill. For example, one can attribute the capital allocation skills of a small entrepreneurial company like MTY Food Group to the CEO rather than to the management team as a whole. So I assume that you primarily take on positions in small and mid-cap companies, right? No, we are market cap agnostic. We buy into companies which have market caps over 15 billion, and then we buy into smaller companies with 100 million market caps in some cases. We don't care about the market cap. We care about the return on equity. And you only invest in Canadian companies, only in Canada. But this approach works anywhere. This isn't unique to Canada. A few guys in Europe looked at my fund. They were either professors or grad students. I don't remember. They wrote to me and said, it's hard to find companies in Europe that actually meet our criteria. It's true. The high ROEs are just not there. But in Asia, it works. I used to do this in Indonesia and in Singapore, and I worked in both of those markets. But what if high ROE comes at a high cost? Currently, the Canadian market's valuation seems overstretched compared to growth prospects in the country. Yeah, valuations are quite rich right now, but we also have a risk-free rate that is somewhere between 1% and 0%. Theoretically, when you work through any of the valuation models and the risk-free growth rate goes down to 1%, you can justify virtually any multiple. But a lot of analysts will say the historical multiple for the market has been 15 times and currently it's at 18 times. Yeah, but interest rates have never been this low in North America, below 1% or at 1%, and maybe moving lower. What risk management mechanisms do you have in place if you're wrong on the direction of the market? We have always been able to go long and short. We short the market. Our biggest tool for risk mitigation right now, though, is put options in the TSX. That's an insurance policy. We buy puts out of money so that they are not that expensive. They won't protect me from a 30% correction, but it should protect me from a 10% correction. And it doesn't cost me that much. So why would you close out the fund to new money? I saw the announcement this week. The reason we're closing the fund is fairly straightforward. If you look at people who manage 200 to 300 million, they can put up really good numbers. But when they start to manage billions of dollars, then that gets really hard in Canada. The market will force you into large caps, which is the most liquid part of the market. I don't mind owning large caps, but I don't want to be in the situation where the small and mid caps don't move the market. In Canada, the mid cap segment is probably the most inefficient part of the market. So it's quite simple. I want to outperform more than I want to manage $3 billion. I don't want to be forced into basically owning the TSX 60. You achieve greater returns in the mid-cap segment of the market. It's inefficient, but there must be other reasons that you outperform the market. I think we have a better methodological approach, and I call it a mousetrap. I didn't invent this style of investing. This is Buffett's style of investing. Why has Buffett been able to achieve a 20% return over 50 years? Because he focuses on companies that are growing at 20%. I also think, though, that measuring growth in terms of return on equity and book value per share is a better way than measuring growth in terms of earnings per share. For example, for 50 years, you can look at Berkshire Hathaway's annual reports and what's on the first page. There's a comparison between the S&P 500's return and Berkshire Hathaway's book value growth side by side. He doesn't spoon feed you. But what he's telling you right there on page 1 is this is how you do it. He focused on book value growth. Right. He said, focus on the growth and the book value per share. Book value per share in old accounting terms was referred to as the net worth of the business. If you focus on the companies where the net worth of the business is growing at a very steady clip, then the share price chart will take care of itself as long as return on equity stays intact. So why haven't other money managers done what you've done to achieve the same higher rates of return? A friend of mine in New York used to say to me that everybody talks Buffett, but only a few people do Buffett. So that would be one aspect of it. Unlike mutual fund managers who have concentration limits, we can concentrate holdings in our portfolio. They can't put 12% of their money into their best idea. And honest to God, if I could only put 3% in any of my best ideas, I think I would still outperform the market. But it wouldn't be as easy if I could instead put 50% of the fund into my 5 best ideas. Because if you're a good stock picker, concentration works in your favor. And if you're not, you should own an ETF, exchange traded fund instead. Truthfully though, if you're going to use concentration and you're not a good stock picker, you're going to be out of the business pretty quickly. Have you ever met Buffett? No, I've been to Omaha, but I've never met him because I'm not in love with the man. I love his ideas and the way he thinks, but I'm not a rock star kind of guy who's like, oh my God, to shake his hand would mean so much to me. That doesn't mean anything to me at all. Obviously, though, if he was around or walked into my boardroom, I would love to hear him speak. But Berkshire Hathaway's annual report is good enough. However, a lot of the best stuff that he wrote was 15 years ago. I have a printout of all the Berkshire Hathaway annual reports going back for the last 50 years. A lot of the stuff from the last 10 years has been more about praising people rather than offering insight into his investment process. So a lot of the stuff that's the best about Buffett has actually been packaged and distilled by other writers. The same can be said of Benjamin Graham. People talk glowingly about reading The Intelligent Investor, which I've read a couple of times, but it's dry. It is dry, especially the chapters on bonds. It's not a great read. And it's long. Yeah, exactly. People who tell you that, oh yeah, The Intelligent Investor is my favorite book, are the same people who tell you that they love jazz, but never go to a jazz club. They say it to be hip and cool, but it's not. There's only 2 chapters in there that I'd recommend to our guys to read. But the people who've written about Buffett are fantastic, such as Mary Buffett's Buffettology. I've read Buffettology. It is a fantastic book. Yeah, so Buffettology is great. If you can get through Snowball, it's great too. But also the one by the Wall Street Journal guy that was written about a decade earlier, American Capitalist. It's only about 270 pages, but I think Buffettology is probably the best out of all the stuff that's been written on Buffett. Some would argue that Buffett was an activist investor in his early days. Going back to your point that companies in the TSX have fantastic products, but through bloated overhead or poor capital allocation, their ROE is usually below 20%. Have you ever considered becoming an activist hedge fund manager? To go on boards and improve capital allocation ROE? Not yet. Maybe that's something down the road, but it's not something that's on my radar screen. In part because we don't buy turnarounds. I might be because we don't have the muscle. We wouldn't own enough stock to be able to push for a turnaround. I continue to look for great companies that are a fair price as opposed to cheap stocks. And that's what Buffett evolved into as well in his career. Any final advice? Yeah, here's my thesis on life. If you want to be a great doctor, don't go to a guy who's a counselor on how to become a great doctor. Go ask a great doctor how to become a great doctor. If you want to be a great investor, then study the great investors and pick one who fits your style, and then master that style. In terms of the way the academics would define it, I'm a growth investor, and actually so is Buffett. But Buffett doesn't like that title. While a lot of people call him a value investor based on the way academics look at value versus growth, he's definitely not a value investor. He was before he met Munger, but then he became a growth investor. Anyway, you must also understand your temperament. And the reason why I say temperament is that you're a value investor, then you're investing in turnarounds. Therefore, you need to know how bankruptcy works. You've got to have an ability to know how boards can turn a company around. So when you say you're going to be a really great value investor, there's a bunch of skill sets that have to come with that. You need to be able to know that once a company goes into bankruptcy, how much is left over and how does that process work? There are a few guys who are value investors who don't have that skill set. I have an undergraduate degree in economics and political science. A lot of what I do involves Porter's 5 forces. It's about competitive advantage. So if you want to invest like I do and you enjoy competitive advantage and you enjoy microeconomics and stuff like that, then this is a good style. But your style of investing has to fit your personality type. And I think that there's a lot more negativity in value investing because you're buying companies that are cheap but are problematic. Whereas I'm buying awesome companies and just hoping that they'll be awesome forever. I get to hang out with the really great CEOs all the time, as opposed to having argumentative discussions with mediocre CEOs who aren't really doing a good job running their companies. Jason Donville's investing lessons. 1, you can get the macro thesis right, but still not get the right stock picks. 2, if I'm adding to a position or subtracting from a position, I don't want the market to know because I don't want people to front run me. 3, where the growth of the world is coming from is a new product development, knowledge-based industries, whereas 99% of us already have Chesterfields, and maybe 1% of us are going to replace them. 4, think about the market as a baseball game. Let's say there's 9 innings in the game. We're now 6 years into this bull market. You never know until it's over, but we're probably in the 7th or 8th or 9th inning of the baseball game. That's usually a bad time to own financials. 5, the time to buy financials is after the market's been corrected. 6, we base decisions on adjusted return on equity as opposed to stated ROE, because the stated ROE doesn't take into account the difference in the dividend policies. 7, first we look for companies with ROE greater or equal to 20%. Second, we look for companies in that high ROE group that are sustainable based on the competitiveness of their products. Third, we assess management's ability to allocate capital at those companies. Once we validate those 3 things, we typically find companies that we can invest in. 8, return on equity can be broken down into 3 pieces through DuPont analysis. You've got good ROE and bad ROE. We want to make sure the ROE is good. 9, you can fake ROE in 1 year, but to achieve high ROE 7 years in a row is tough. So when I see a company that has achieved an ROE of 23, 22, 23, 24, 23, 22% over the past 7 years, without even knowing what the industry they're in, I go, wow, there's something in place here. 10, if you're thinking of investing in 2 companies and you run the numbers over the last 7 years in both companies and you put them side by side, the good company will leap off the page at you. 11, the great enemy of a high ROE company is competition. 12. Most of the companies we own have people running them that are very good capital allocators. Because if you can keep your ROE over 20% year after year, you almost by definition are a good capital allocator. 13. Our biggest tool for risk mitigation right now is put options. That's an insurance policy. That won't protect me from a 30% correction, but it should protect me from a 10% correction. 14. In Canada, the mid-cap segment is probably the most inefficient part. 15. Measuring growth in terms of return on equity and book value per share is a better way than measuring growth in terms of earnings per share. 16. If you focus on companies where the net worth of the business is growing at a very steady clip, then the share price chart will take care of itself. 17. If you're a good stock picker, concentration works in your favor, and if you're not, you should own an ETF. 18. We don't buy turnarounds. We wouldn't own enough stock to be able to push for a turnaround. I continue to look for great companies that are fair price as opposed to cheap. That was 19. 20. If you want to be a great investor, then study the great investors and pick one that fits your style and then master that. 21. Your style of investing has to fit your personality. 22. I'm buying awesome companies and just hoping that they'll be awesome. I get to hang out with the really great CEOs all the time as opposed to having argumentative discussions with mediocre CEOs who aren't doing a very good job running their companies.